I made $100 million in the 1929 crash, while others lost everything. In the next 40 minutes, I'll reveal exactly how I predicted the greatest market collapse in history and positioned myself to profit while the financial world burned. This single principle of market timing, identifying when euphoria turns to panic, has been the cornerstone of my greatest trades. The strategy I'm about to share doesn't just apply to once-in-a-century crashes. It works in every significant market downturn since I first employed it. I saw the 1929 crash coming months before it happened, not because I'm clairvoyant, but because I developed a sixth sense for market sentiment after decades of watching how prices move. The market always tells you what it's going to do, if you know how to listen. By September 1929, I had built up a massive short position worth over $3 million. My brokers thought I'd lost my mind. "Jesse, you're betting against the greatest bull market in history," they warned. But I saw what others refused to see: unsustainable speculation, margin debt at record levels, and declining market breadth disguised by a handful of soaring stocks. The signs were everywhere for those willing to look. Blue-chip stocks trading at 50 times earnings, taxi drivers and shoeshine boys giving stock tips, average Americans leveraging themselves to the hilt to buy shares. I'd seen this movie before in 1907 and 1921. Irrational exuberance always ends the same way. When Black Thursday hit on October 24, 1929, panic swept through Wall Street. By Black Tuesday, October 29th, the market had lost over 25% in 4 days. While bankers jumped from windows and ordinary Americans watched their life savings evaporate, my short positions multiplied in value exponentially. Within weeks, my $3 million bet had turned into over $100 million, equivalent to billions in today's money. But here's what most don't understand. My success wasn't about timing a single event. It was about recognizing a fundamental pattern that repeats throughout market history. Markets climb the stairs up and take the elevator down, always. The strategy I used in 1929 is the same one I employed in previous crashes, and it's the same approach that still works today. The market's nature hasn't changed because human psychology remains constant. Fear and greed drive prices, not fundamentals. I'm going to teach you exactly how to spot these patterns before they fully develop, how to position yourself correctly when everyone else is blinded by euphoria, and most importantly, how to maintain the emotional discipline to act when your instincts scream at you to do the opposite. I was born into humble beginnings on a Massachusetts farm in 1877. Farm life taught me patience and observation, skills that would later serve me well on Wall Street. By age 14, I'd grown restless with farm work and school. The numbers in my textbooks fascinated me more than the lessons themselves. I could see patterns where others saw only figures. At 15, I convinced my parents to let me leave for Boston, where I landed a job as a quotation board boy at Payne Weber. My task was simple: update stock prices on the board as they came through the ticker. Hour after hour, I watched those numbers flow, developing what I later called my tape-reading ability, seeing the market's true intentions behind the constant stream of prices. I made my first trade at age 15 with $5 borrowed from a friend. That trade netted me $3.12 in profit, a fortune to me then. By 16, I'd saved $1,000 from my trading profits, equivalent to about $30,000 today. The brokerage houses soon banned me from their premises because my uncanny ability to predict price movements was disrupting their business. This forced me to seek out bucket shops, illegal gambling operations disguised as brokerages. These establishments took the opposite side of customers' trades, betting against them. They counted on most traders losing money. I became their worst nightmare, a consistently profitable trader. One by one, these bucket shops banned me, forcing me to wear disguises and use runners to place my trades. By 20, I had accumulated over $10,000. At 22, I moved to New York City with $2,500 in my pocket, ready to take on the real Wall Street. The transition wasn't easy. The rules were different, and my bucket shop tactics didn't work as well. I went broke several times, rebuilding my fortune from scratch each time. I learned that Wall Street was not the bucket shops. Here, timing was everything. Volume mattered. Market psychology dominated. I developed my own trading philosophy based on price action, patience, and capital preservation. By 1907, during the banking panic, I made my first million by shorting the market. In 1929, I anticipated the Great Crash and made approximately $100 million in today's dollars by again shorting the market. The press called me the Great Bear of Wall Street and the Boy Plunger. My journey from farm boy to Wall Street legend wasn't linear. I experienced devastating losses alongside spectacular gains. I went bankrupt 3 times. Each failure taught me something valuable about the market and about myself. These hard-won lessons shaped my trading methods, which I'll share with you now. The wisdom I gained came at a tremendous cost, but you have the advantage of learning from my experiences without paying the same price. Let me share with you my most powerful discovery, the pivot point method. This isn't some complex algorithm requiring a mathematics degree. It's a straightforward principle I developed after years of painful losses and spectacular gains. I've used it to make millions while others were losing everything. The market telegraphs its intentions before major moves. I learned to identify these pivot points, specific price levels where the market psychology shifts. When a stock tests a previous high or low multiple times, pay extremely close attention. The third test is critical. If the price breaks through, a substantial move often follows in that direction. I remember applying this in 1907 during the banking panic. While most traders were paralyzed with fear, I observed Union Pacific repeatedly testing its support level. When it finally broke below on the 3rd attempt, I knew with absolute certainty what would happen. I shorted aggressively. The stock plummeted, and I walked away with over $1 million, roughly $30 million in today's money. But identifying pivot points requires more than just watching price levels. You must study volume patterns. When a stock approaches a previous high with increasing volume but fails to break through, that's telling you something critical. The big money is distributing shares. I look for divergence between price action and volume. It's like hearing the market whisper its next move. In 1929, I spotted this pattern across multiple market leaders. Prices kept climbing, but volume characteristics changed. Distribution was happening right before everyone's eyes, yet they couldn't see it. I positioned myself accordingly and made $100 million when the crash came. My pivot point method also applies to market sentiment. I track when public enthusiasm reaches extremes. When taxi drivers and shoeshine boys start giving stock tips, I prepare to move in the opposite direction. The crowd is always wrong at crucial turning points. The beauty of my method is its simplicity. I don't need complicated indicators or algorithms. I watch price, volume, and sentiment at key levels. When these align at historical pivot points, I act decisively with size. Remember this: markets move from undervalued to overvalued and back again, repeatedly. By identifying the pivot points where this shift occurs, you position yourself ahead of the crowd. I've used this principle to build and rebuild my fortune multiple times. The pivot point method isn't just a technique. It's the cornerstone of my entire trading philosophy. Master this, and you'll see the market through entirely different eyes. The formula I developed wasn't meant to be shared widely. Wall Street buried my methods for a simple reason: they work too well. When I made $100 million in 1929 by shorting the market before the crash, the financial elite didn't celebrate my achievement. They feared it. My system threatened their control over market information. My formula has three components that Wall Street doesn't want retail traders to understand. First, I track what I call pivot points, critical price levels, where the market reveals its true direction. These aren't arbitrary support and resistance levels that most technicians obsess over. My pivot points emerge from the market's own behavior, showing exactly where big money is positioning itself. Second, I developed a sizing methodology that Wall Street executives consider dangerous. I never risk more than 10% of my capital on a single trade, but I scale up aggressively when the market confirms my thesis. In 1907, I turned $10,000 into $1 million during the banking crisis using this precise method. The establishment wants you trading fixed lot sizes. It makes your behavior predictable. Third, and most threatening to the financial elite, is my principle of emotional detachment. I don't trade on tips, rumors, or news. The market itself tells me everything I need to know through price action. When I see a genuine pivot point forming and volume confirming the move, I act without hesitation or emotion. This approach strips power from those who manipulate markets through controlled information flow. Wall Street buried these principles because they democratize market success. My methods don't require insider connections or expensive data feeds, just disciplined observation and execution. During the 1907 panic, bankers were shocked when I profited while their own portfolios collapsed. They couldn't understand how someone outside their circle could read the market so clearly. The financial establishment actively discourages traders from studying my methods in depth. They've reduced my legacy to simplistic quotes while burying the systematic approach that generated my success. They'd rather you follow conventional wisdom that keeps you trading in patterns beneficial to institutional players. I paid a heavy price for discovering these truths. My fortune was made and lost several times because even I sometimes abandoned my own principles. The market punishes this mercilessly. The true formula isn't just about entry and exit points. It's about maintaining absolute discipline in the face of market irrationality. That's the part Wall Street most wants to keep hidden, because disciplined traders are impossible to manipulate. The pivot point method changed everything for me in 1923. While other traders were still relying on tips and rumors, I had developed a mathematical approach to identifying key market turning points. Let me show you exactly how I use this method to generate millions during one of the most volatile periods in market history. I discovered that markets tend to rotate around specific price levels, what I call pivot points. These aren't arbitrary numbers. They're psychological barriers where buying and selling pressure reach equilibrium. When price breaks through these levels with conviction, I know a significant move is underway. Here's my exact calculation. I take yesterday's high, low, and close, add them together, then divide by 3. This gives me the central pivot. From there, I calculate 2 resistance levels above and 2 support levels below. The formulas are precise. I don't leave anything to chance. In April 1923, I watched U.S. Steel approach a key pivot at $112. Most traders saw nothing special about this price, but my calculation showed it was a critical decision point. When it broke through on heavy volume, I immediately bought 10,000 shares. Within 3 weeks, I'd captured a 22-point move while others were still wondering what happened. The beauty of pivot points is their self-fulfilling nature. Because enough traders watch these levels, they become real barriers in the market's collective mind. I don't fight this psychology, I exploit it. My discipline with pivot points is absolute. When price respects a pivot as resistance, I look for short opportunities. When a pivot acts as support, I consider longs, but, and this is crucial, I always wait for confirmation. A mere touch of a pivot means nothing without the right volume and price action to confirm. I learned this lesson painfully in the summer of 1923. I saw Radio Corporation approach a pivot at $33.25 and anticipated a breakout. I entered early without confirmation and watched in frustration as it reversed sharply, stopping me out for a substantial loss. The market taught me patience that day. The pivot method isn't just about entry points. It defines my entire risk management strategy. I place my stops just beyond the next pivot level, where the market has already shown its hand. This isn't arbitrary. It's respecting what the market itself is telling me about support and resistance. I've refined this method through thousands of trades. While others chase headlines, I track these mathematical inflection points with religious dedication. The market doesn't lie at these levels. It reveals its true intentions to those patient enough to listen. By summer of 1929, I could feel it in my bones. The market had become a circus of speculation, with shoe shiners and taxi drivers giving stock tips. This wasn't investing anymore. It was gambling, pure and simple. I'd seen this movie before in 1907, and I knew exactly how it would end. The ticker tape couldn't keep up with the trading volume. That's always a dangerous sign, when technology can't match the frenzy. In August, I began quietly building my short positions. My brokers thought I was insane. "Jesse, this bull market has years to run," they told me, but the charts were speaking to me clearly. I noticed something critical that others missed: divergence between the industrials and the railroads. The transportation stocks were already declining, while the industrials kept climbing. This told me the real economy was slowing, even as speculation accelerated. I've always said the market is never wrong. Interpretations are. By September, I'd committed nearly my entire fortune to short positions. I slept fitfully those nights, not from doubt, but from the weight of conviction. The margin debt levels had reached absurd heights, people borrowing heavily to buy stocks they barely understood. When October arrived, the market began showing weakness. Small cracks at first, failed rallies, lower highs. On October 24th, what they later called Black Thursday, the dam finally broke. The market plunged, and then came the pathetic bounce as the bankers tried to stem the bleeding. I didn't cover a single short. I knew this wasn't the bottom. The real panic was still to come. And on October 29th, Black Tuesday delivered the final blow. The market lost 12% in a single day amid unprecedented volume. While others lost everything, I made nearly $100 million in today's dollars, not because I was smarter, but because I respected the market's patterns and had the discipline to act on my convictions. The lesson? Learn to read the tape, not the newspapers. By the time financial news acknowledges a major shift, the smart money has already positioned itself. And remember, the crowd is usually wrong at major turning points. When everyone agrees on the market's direction, prepare for the opposite. Most importantly, I never let hope influence my trading decisions. Hope is the enemy of the trader. The market doesn't care what you want or what you paid for a position. It only responds to supply and demand, the eternal laws that govern all markets. The 1929 crash wasn't luck or coincidence. It was the inevitable result of excess, and the patterns were there for anyone willing to see them. Let me be clear about something. The core principles of trading haven't changed since my day. The psychology of markets remains constant because human nature is constant. What has changed are the tools at our disposal. I once tracked market movements with pencil and paper in my little black books, meticulously recording price patterns by hand. Today, you have algorithms that can process millions of data points per second. I would have killed for the technology you now take for granted. When I traded, I had to physically visit bucket shops and brokerage offices to see ticker tape prices. Information traveled slowly. Today, you have real-time data from every market on Earth in your pocket. But this abundance creates its own problems. The greatest danger of modern trading technology is the illusion of control. Just because you can see more doesn't mean you understand more. I've watched countless traders drown in data while missing the fundamental patterns. They have 15 screens showing oscillators, Fibonacci retracements, and momentum indicators, yet they miss what the market is actually saying. If I were trading today, I'd strip away 90% of what most traders use. I'd focus on price action and volume, just as I did a century ago. The tools might be digital now, but my approach would remain analog in its simplicity. I'd still look for the path of least resistance. I'd still wait for confirmation before entering positions. I'd still cut losses ruthlessly. Mobile trading apps would have been particularly dangerous for me. The constant availability of markets could have fed my addiction. I would have needed strict rules about when I could and couldn't trade. Remember, overtrading killed more of my accounts than any market crash. Social media presents another modern danger. In my day, I had to battle the opinions of friends and brokers. Today, you face an endless stream of market opinions. Each tweet, each post, each YouTube guru threatens to pull you from your own judgment. I would have avoided these platforms entirely while actively trading. The one technological advancement I would embrace is backtesting. The ability to test strategies against historical data would have saved me years of painful lessons. But even here I'd be cautious. Markets change. What worked in the past may fail in the future. Remember this. Technology should serve your strategy, not define it. The tools change, but the game remains the same. Master yourself first, then master your tools. That's how you translate the wisdom of pencil to the power of pixel. Psychology is the ultimate battleground in trading. I learned this through decades of both triumph and ruin. The market doesn't reveal its secrets through charts alone. It exposes them through the behavior of its participants. My greatest edge came not from technical analysis, but from mastering my own mind. I developed a mental framework that separated me from the crowd. First, I cultivated absolute emotional detachment. When I enter a position, I eliminate all hope, fear, and regret. These emotions are poison to a trader's judgment. In 1929, while others panicked as the market collapsed, I maintained ice-cold discipline. This wasn't natural. It was a skill I deliberately cultivated through years of practice. Second, I learned to think in probabilities, not certainties. The amateur seeks guarantees. The professional accepts calculated risk. Every trade I make has a probability of success and failure. By understanding this mathematical reality, I freed myself from the crippling need to be right all the time. My goal became to be right more often than wrong, and more importantly, to be more right when I'm right than wrong when I'm wrong. Third, I developed what I call market intuition, a subconscious pattern recognition that alerts me to shifts before they become obvious. This isn't mystical. It's the result of immersing myself in market behavior for decades. My mind processes thousands of subtle cues that my conscious brain cannot articulate. When something feels wrong about a market, I've learned to listen. Fourth, I practice strategic patience. The market rewards those who wait for the perfect setup. I might go weeks without trading, then commit heavily when conditions align. Most traders feel compelled to act constantly, a psychological weakness the market exploits mercilessly. Finally, I maintain complete intellectual honesty. When I'm wrong, I acknowledge it immediately. No excuses, no rationalizations. This allows me to cut losses quickly and preserve capital for future opportunities. The market doesn't care about my ego or my theories. It only responds to reality. These psychological principles transformed my trading far more than any technical system. The greatest enemy you face isn't the market or other traders, it's yourself. Master your psychology, and you've mastered the hardest part of trading. The patterns on the chart are meaningless if the patterns in your mind remain destructive. The pivot point method saved my fortune during the panic of 1907. While others were losing everything, I identified key reversal points and positioned myself accordingly. Let me reveal exactly how I execute this strategy that has served me for decades. I developed my pivot point method through painful trial and error. In essence, I identify price levels where the market psychology fundamentally shifts. These aren't arbitrary numbers. They represent the battlefield between bulls and bears, where one side finally surrenders. In October 1907, I watched Union Pacific closely as panic gripped Wall Street. The stock had fallen from 160 to 100 in a matter of weeks. Most traders were paralyzed by fear, but I was calculating my pivot points. When Union Pacific touched 100 and bounced slightly, I noticed something critical. The selling pressure momentarily exhausted itself. The pivot had formed. Here's exactly how I execute the method. First, I identify a stock showing extreme movement in one direction. Then, I watch for signs of exhaustion, volume diminishing on continued price movement, or a failed attempt to make a new high or low. This signals the potential pivot forming. I then draw horizontal lines at significant previous highs and lows on my charts. These become my pivot zones. When price approaches these levels during a strong trend, I prepare for possible reversal. The key is patience. I wait for confirmation before acting. In 1907, when Union Pacific bounced off 100 and closed higher for 2 consecutive days, with increasing volume, I knew my pivot was confirmed. I established a substantial long position while others were still selling in panic. Within 3 weeks, I'd captured a 30-point move, while the financial world was still licking its wounds. The beauty of pivot points is their universal application. I've used them in stocks, commodities, and later in my career, currencies. The market's memory is long, and these psychological price levels remain significant across time. My method differs from what most call pivot points today. I'm not using mathematical formulas based on previous days' high, low, and close. I'm identifying true psychological turning points where the market's entire character changes. Remember, pivot points aren't just numbers. They're manifestations of mass psychology. When you learn to read them correctly, you're essentially reading the collective mind of the market. This skill alone would have saved countless fortunes in 1907, 1929, and every major market event since. Let me show you how I apply my core principles in today's markets. I've spent decades perfecting my system, and while technologies change, human psychology doesn't. I recently back-tested my pivot point strategy against the last decade of market data, and the results were exactly as I expected. Profitable in both bull and bear cycles. I identified 7 major market pivots between 2010 and 2023, where following my method would have yielded substantial returns. The 2018 December sell-off presented a perfect example. While most traders panicked as the S&P dropped nearly 20%, I recognized the classic pivot formation, extreme sentiment readings, technical oversold conditions, and the familiar pattern of 3 down days followed by a failed rally attempt. This is precisely when I begin scaling in. My backtests confirm what I've always known. Patience remains the ultimate edge. During the March 2020 crash, most traders either froze or capitulated near the bottom. My system identified the pivot point on March 23rd, the exact day markets bottomed. The key signal? Extreme put-call ratios coupled with 3 consecutive 90% down days, followed by the first strong up day on volume. I've modernized my methods with technology, but the foundation remains unchanged. I now use algorithms to monitor my pivot indicators across multiple time frames simultaneously. My system scans for stocks showing the exact price patterns I've always traded, but now I can monitor thousands of securities at once. The computer doesn't make decisions. It simply flags potential pivots for my review. My most recent backtest revealed something fascinating. My method would have signaled to exit tech stocks in November 2021, almost precisely at the top. The indicators I've relied on for decades, excessive public enthusiasm, parabolic price movement, and deteriorating market breadth, all appeared just as they did before previous major tops. The beauty of my approach is its simplicity. I've programmed my algorithms to alert me when price breaks above or below key pivot levels with increased volume, nothing more. I avoid the complexity trap that ensnares most modern traders. They build systems with dozens of variables that look impressive but fail in real markets. I still maintain my trading journal meticulously, though now it's digital. Each trade is documented with the specific pivot signal that triggered my entry, complete with screenshots and notes. This disciplined record-keeping has been essential to refining my method over decades. The markets change, but winning still requires the same psychological fortitude it did a century ago. As I sit here in my Manhattan apartment overlooking the bustling city below, the market has been giving signals that few seem to recognize. The psychological component of trading isn't just important, it's everything. I've made and lost millions multiple times, and each cycle taught me the same lesson. Your mind is your greatest asset and your most dangerous liability. When I lost my entire fortune in the 1907 crash, it wasn't my strategy that failed me. My strategy was sound. What failed was my psychological discipline. I violated my own rules because fear and greed hijacked my decision-making process. I've since developed mental safeguards that protect me from myself. First, I never allow myself to become emotionally attached to any position. The moment you fall in love with a stock is the moment you lose objectivity. I've watched countless men go broke defending their precious theories about what a stock should do. The market doesn't care about your theories. It doesn't care about your hopes. It doesn't care about your needs. Second, I maintain complete isolation when making critical decisions. Notice the silence in this apartment? That's by design. When evaluating market conditions, I shut out all external opinions. No newspapers, no broker advice, no tips from friends. The ticker tape tells me everything I need to know. External voices only cloud judgment and introduce bias. Third, I keep a detailed trading journal. After each significant trade, I document not just what I did, but why I did it and how I felt while doing it. Patterns emerged that revealed my psychological weaknesses. I discovered I was particularly vulnerable to overtrading after a string of successes, a pattern that cost me millions in 1908. Most importantly, I've learned to embrace my mistakes rather than deny them. When I'm wrong, I exit immediately. No hesitation, no rationalization. This single principle has saved me more money than any other trading rule I follow. Psychological discipline isn't something you achieve once and possess forever. It's a daily practice. Even now, after decades of trading, I feel the pull of destructive emotions. The difference is I recognize them instantly and have systems to neutralize their influence. Remember this: your trading strategy is only as good as your ability to execute it consistently under pressure. Master your psychology, and you've mastered the hardest part of trading. Everything else is just mechanics. Let me be absolutely clear about implementing this strategy. You must treat it like a professional business, not a casual hobby. I've learned this distinction through decades of painful losses and spectacular gains. When I approach the market like a disciplined business, I win. When I get emotional or casual, I lose everything. My implementation framework has 5 non-negotiable elements. First, position sizing is everything. I never risk more than 2% of my capital on any single trade. This rule saved me countless times when I was wrong, and I'm wrong often. The difference between amateurs and professionals isn't being right more often. It's how we manage being wrong. Second, I document every trade with meticulous detail. In my trading journals, I record not just entries and exits, but my emotional state, market conditions, and reasoning. When I review these journals during market lulls, patterns emerge that would otherwise remain invisible. Your memory will lie to you about your trading. My journals never do. Third, I create rules for myself in advance and follow them religiously. The market will test your discipline in ways you cannot imagine. During the 1907 panic, I had predetermined rules that forced me to hold my short positions despite enormous pressure. Those rules made me millions while others were ruined. Fourth, I maintain absolute emotional detachment. The market doesn't reward your hopes or punish your fears. It simply exists. I've trained myself to feel nothing when trading. No excitement on wins, no despair on losses. This emotional control took me decades to develop, but without it, you'll eventually self-destruct. Finally, I take regular breaks from the market. Even at my peak, I stepped away completely for weeks at a time. The market will always be there. Your mental clarity might not be. Some of my best trades came after periods of complete detachment. Now, a serious warning. This approach will feel unnatural and uncomfortable. Your instincts will fight against these principles. When I first implemented strict position sizing, it felt like I was leaving money on the table. When I forced myself to document failures, my ego screamed in protest. When I stepped away during volatile markets, everything in me wanted to jump back in. But remember this: the market has transferred more wealth from emotional traders to disciplined traders than perhaps any other mechanism in financial history. I've been on both sides of that transfer. Trust me when I say, the disciplined side is infinitely more profitable.